All right, strap in, everybody. Let's take a deep dive into this whole money creation thing. It's something we all use, but uh, how many of us really understand how it comes into being?
It can feel kind of mysterious, right? Like, where does money actually come from?
Exactly. And how does it impact our lives, our economies?
Well, we're going to use some really interesting sources to unpack this.
We've got Wikipedia articles on the Great Depression,
Yeah.
on money creation itself,
We've got some excerpts from J.D. Alt's The People's Money.
which is a really thought-provoking piece, by the way.
Absolutely. And to kick things off, we're going to start with this YouTube video. The title translates to The System of Money Central Banks Financial Documentary Creation of Money Debt.
Catchy, right?
Well, it makes a pretty bold claim. It says that only 3% of all the money out there is actually created by, central banks, like the Federal Reserve here in the U.S.
Oh, wait, only 3%.
Yeah. So naturally, the question is, where does the other 97% come from?
Right. I mean, I always thought banks just lent out the money that people deposited.
That's what most of us think.
Yeah.
But according to this video, and actually even institutions like the Bank of England, the vast majority of money, we're talking 97.4%, is created by commercial banks when they give out loans.
Hold on. So they're basically just, like, making money out of thin air.
Essentially, yeah. And it's not about physically printing bills. It's all digital.
Wow. Okay.
Yeah.
My mind is a little blown right now. So if I go to the bank for a loan, what's actually happening?
Well, when a bank issues you a loan, they're not pulling money from a vault. They're creating a new deposit in your account, which increases the overall money supply.
So more money is just appearing.
In a sense, yes.
Doesn't that cause, like, massive inflation?
That's a natural concern. The relationship between money creation and inflation is complex and debated by economists,
Yes.
but it's influenced by a lot of factors.
Like what?
Well, you've got the overall health of the economy, government spending, how much people are buying.
So it's not a simple one-to-one thing.
Right. And this is where central banks come in. Like the Fed, they try to manage this balance, influence how much money is circulating through things like interest rates and reserve requirements for banks.
So they're trying to keep the system from going haywire.
Exactly. But the big question is, where does this leave us regular folks? The people actually using this money, what are the real-world effects of this whole system? That's where things get interesting and potentially a little uncomfortable. Because one of the major criticisms of this system is that it can lead to a concentration of wealth and, economic instability.
So the rich get richer.
Yeah. Because banks are profit-driven, they tend to lend to those who are already wealthy. They're seen as less risky, and this can just worsen existing inequalities.
Makes sense. And what about this economic instability?
Well, think about the Great Depression. We'll be getting into that more later. But one of the key factors was a sudden shrinking of the money supply. When banks stopped lending, the amount of money circulating plummeted. Businesses went under. Unemployment skyrocketed.
Yikes. So this money creation thing is kind of a big deal. It's not just numbers on a screen.
Absolutely, it impacts all of our lives, and that's why it's so crucial to understand how it works.
And maybe even question if it's the best system we could have.
Exactly.
All right, well, on that note, let's take a closer look at the Great Depression and see how this system and maybe its flaws played a part in that historical turning point. So we've seen how this money creation thing, largely controlled by banks, can have some pretty huge consequences.
Yeah, for sure. And to really grasp the impact of this system, it helps to look back at history, see how it's played out.
Like with the Great Depression, right?
Exactly. The Great Depression is a perfect example. It shows just how fragile the whole financial system can be, how interconnected the global economy really is.
I mean, we're talking massive bank failures, unemployment through the roof, industrial production plummeting.
It was a total economic upheaval.
And the Wikipedia article, the one on the causes of the Great Depression, it lists out all these factors.
Yeah, it was a lot of things coming together.
But there's this one view, the monitor's view, that says the Federal Reserve's actions actually made things worse.
Right. Popularized by Milton Friedman.
So what did the Fed do? Or, I guess, not do?
Well, Friedman argued that after the stock market crash in 29, the Fed actually tightened monetary policy, reduced the amount of money in circulation.
Instead of, like, loosening things up.
Yeah, and that led to a credit crunch. Businesses couldn't borrow, people couldn't spend.
So they basically did the opposite of what they should have.
According to Friedman, yeah. He believed they should have provided emergency loans to banks, like they did in 1907 during the panic. Increase the money supply to try and stabilize things.
Wow. It's kind of scary to think that a small group of people at the Fed could have that much power.
It highlights the massive responsibility they have, for sure. Their decisions can make or break entire economies.
And the Great Depression is a pretty stark reminder of that.
Absolutely. Sound monetary policy is essential, and a central bank that can step in as a lender of last resort during a crisis.
But didn't debt deflation also play a role in the Great Depression?
Ah, yes. Debt deflation. Now, this is where it gets really interesting.
Okay, hit me with it.
So, the Wikipedia article on debt deflation describes this vicious cycle. Basically, when prices drop too quickly, it can actually lead to a decrease in overall demand.
Wait, so lower prices are bad?
Not always, of course. But when prices fall too rapidly, people tend to hold off on buying things. They think, hey, maybe it'll be even cheaper tomorrow.
Makes sense.
But that leads to less consumer spending, which hurts businesses. Then they have to lay people off, which further decreases demand. It's this downward spiral.
So it's not just about how much money is out there, but also about how people feel, their expectations.
Exactly. During the Great Depression, that fear and uncertainty combined with the Fed's policies, well, it created the perfect storm.
It all just kind of snowballed.
Yeah, and if you factor in that most of the money supply was created by commercial banks, which were failing left and right, you can see how the whole system just froze up.
So we've got money creation, the Fed's actions, and then this whole debt deflation spiral. It paints a pretty bleak picture.
It was a dark time, for sure. But it offers valuable lessons for us today.
Absolutely. So let's shift gears a bit. How have international monetary systems changed over time? Have we learned from the mistakes of the past?
That's a great question. It takes us on another journey, from the gold standard to Bretton Woods, and then to the floating exchange rates we have now.
All right, so let's start with the gold standard. I know it gets praised for its stability, but the Wikipedia article on the International Monetary System suggests it wasn't all sunshine and roses.
Yeah, the gold standard had its drawbacks. For one thing, it limited what governments could do to manage their own economies.
How so?
Well, the value of a currency was directly tied to gold. So that meant the amount of money a government could print was restricted by how much gold they had.
Ah, I see.
So let's say your economy needs a boost. You can't just print more money to encourage spending and investment because you're stuck with whatever amount of gold you've got.
So even though tying currency to gold sounds stable, it can actually be a problem.
Exactly. It can be too rigid, not responsive enough to changing economic conditions.
So what came after the gold standard?
Well, after World War II, you had the Bretton Woods system. It tried to strike more of a balance, allow for more flexibility, but still keep things relatively stable.
And how'd that work?
Currencies were pegged to the US dollar, which is then convertible to gold at a fixed rate. The idea was to facilitate international trade and prevent wild swings in currency values.
Sounds reasonable.
Yeah.
But that system didn't last forever either, right?
No, it collapsed in the early 1970s.
What happened?
There were growing concerns about the US dollar being able to maintain its link to gold, and that ultimately led to the system's downfall.
So then we ended up with the floating exchange rates that we use today.
Right. Now, currency values are basically determined by market forces, supply and demand.
So we've gone from gold to the dollar and now to this free-floating system. It seems like we're constantly searching for the right balance.
Exactly. Stability versus flexibility. And each system has its pros and cons. The gold standard was predictable but inflexible. Bretton Woods offered more flexibility, but wasn't sustainable in the long run. And floating exchange rates allow for more autonomy, but they can also lead to volatility and uncertainty.
It's a complex landscape. But through all of this, I keep thinking about who benefits from these systems and who ends up bearing the costs.
That's the key question, isn't it? And that's where J.D. Alt's essay, The People's Money, comes in. He argues that the way things are set up now, with the focus on profits and this tendency towards crises, often leaves the most vulnerable people behind.
And he thinks there's a better way, right?
Yes. He believes we can use our knowledge of money creation to build a more just and equitable system, one that actually works for the people, not against them.
Okay, I'm definitely interested to hear more about that.
Well, that's exactly what we'll be diving into in the last part of our deep dive.
Okay, so we've journeyed through this whole world of money creation, seen how central banks tried to manage it, how things went sideways during the Great Depression. But the big question now is, can we use all this knowledge, all these insights, to build a better system?
That's the challenge, right? And J.D. Alt, in The People's Money, he argues that we shouldn't just accept the limitations of the current system.
We should actively try to change it.
Yeah. He sees money creation as this incredibly powerful tool, but a tool that can be used for good or for bad.
And right now, it feels like it's mostly used for, private gain, profit.
He makes a distinction between private enterprise and public enterprise.
Right.
Private enterprise is all about maximizing profits, right?
Yeah.
But public enterprise, that's about the well-being of everyone, even if it doesn't always turn a profit.
So things like education, healthcare, infrastructure,
Mhm.
stuff that benefits society as a whole.
Exactly.
But those often get shortchanged, right?
Right.
Because they're not always profitable in the traditional sense.
And Alt argues that we need to shift our thinking. Money shouldn't just be about enriching a few. It should be a tool for solving our collective problems.
I like that idea. But how do we get there? How do we move from a system that prioritizes profit to one that puts people and the planet first?
Well, he suggests that we can leverage the existing system with the Fed at the center, but instead of just creating money for banks to lend out, the Fed could create money specifically to fund things that benefit everyone.
So like direct investment in renewable energy, affordable housing.
Precisely, aligning money creation with our societal goals. Imagine the possibilities if we directed those trillions of dollars towards a sustainable future, towards improving people's lives.
It's a compelling vision. But wouldn't that lead to massive inflation?
It's a valid concern, and All addresses it. He's not talking about just printing money recklessly. The key is strategic investment.
Strategic in what way?
Investments that boost productivity, create jobs, and address long-term challenges. It's about investing in our future, not just throwing money at problems.
Okay, that makes sense. But even with strategic investment, how do we make sure this power isn't misused? How do we make it democratic?
That's the crucial question. And Alt emphasizes transparency and accountability, giving communities and citizens a real say in how money is created and how it's used.
It's definitely a radical shift,